Dirty dealings, corporate battles, consumer woes. This is Evening 5. Gateway Development Alliance, or GDA, the consortium proposing to privatise Malaysia Airports Holdings, has once again extended the closing time and date for the acceptance of its takeover offer, this time to 5 p.m. on January 24th, 2025, from 5 p.m. on January 17th, 2025. Save for the extended closing date, all other details, terms and conditions of the takeover offer, including the offer price of 11 ringgit per share and the acceptance condition of 90% of the total issued MAHB shares, remain unchanged. According to a filing on Bursa Malaysia today, GDA, comprising the EPF, Khazanah National, the Abu Dhabi Investment Authority and BlackRock Inc.-backed global infrastructure partners, has already held 86.18% in the airport's operator as at 5 p.m. today. This includes the shares transferred to the offerers, but pending receipt of the acceptance document. As with the previous extension announcement, the offerers reiterated their view that the offer is compelling as it presents holders the opportunity to realise their investment in MAHB for cash. Transport Minister Anthony Loke has expressed hope for the swift finalisation of MAHB's privatisation. According to a Bernama report, Loke voiced his support for the corporate exercise proposed by the Gateway Development Alliance, or GDA. Loke reiterated his dissatisfaction with previous delays in decision-making within the airport's operator, citing the Aerotrain project as a prime example. The replacement project, which is still in the testing stage, does not have a confirmed completion date. Loke believes MAHB's privatisation will help streamline processes, leading to faster implementation and greater accountability, and enable it to respond more swiftly to industry demands and accelerate its capacity expansion. The minister noted that several ongoing projects, including capacity building at KLIA, have yet to be completed. He stressed the importance of not only upgrading the infrastructure, but also boosting marketing initiatives to attract more airlines into Malaysia. Poh Kong Holdings is expecting improved sales in 2025, driven by a positive retail environment in Malaysia and a strong domestic economy. Poh Kong's Ermin Siao Deming said the jewellery retailer is planning to open 2 more outlets this year. This optimism is backed by the Retail Association's projection of a 5.5 to 6% growth in retail sales this year, on the back of an anticipated economic growth of at least 4.5 to 5%. Xiao said Poh Kong's sales are already on an upswing, and the company is anticipating a further jump with Chinese New Year around the corner. And based on engagement with the government, he said it is understood that luxury tax will be put on hold for the moment. Gold reached an all-time high of $2,790.07 per ounce in October last year. However, unlike the strong uptrend in 2024, Poh Kong expects gold prices to be more volatile in 2025, fluctuating between $2,400 and $3,000, driven by the overall global economy and geopolitical tensions. Global real estate consultant Knight Frank said more needs to be done to enhance the competitiveness of the Johor-Singapore Special Economic Zone in order to attract investments. During a forum in Kuala Lumpur, its executive director Amy Wong Siew Fong highlighted some comparisons between Johor and Singapore. She pointed out that Singapore's lower corporate tax rates and talent pool render it a more attractive investment destination, which Johor lacks. While acknowledging that the JS-SEZ is still in its nascent stages of development, Wong stressed that incentives remain a critical factor in attracting investments. She highlighted that small and medium enterprise players and multinational corporations in Singapore are still awaiting clear incentives before making any commitments. Still, Wong said Malaysia's stable political environment is a key driver to spur investments in the property sector, but she cautioned that China's economic slowdown could pose a risk for the property sector, particularly in industrial properties. SEZ State Builder said its joint venture with Anjung Maria has been shortlisted by the Energy Commission to develop a 4-megawatt large-scale solar photovoltaic project in Perlis. The joint venture between Anjung Maria and SEZ State's subsidiary SEZ State Construction is 40% owned by the unit and 60% by Anjung Maria. SEZ State's Deputy Chairman Kwee Genevieve controls Anjung Maria with a 97.18% stake. In an exchange filing, SEZ State said the latest award aligns with the company's mission to develop up to 3,000 megawatt solar power plants and up to 3,000 affordable houses with solar power roofs. The group plans to finance the project through a combination of debt and equity, which it said is not expected to have a material effect on the company's gearing position. As of October 31st, 2024, SEZ State had cash and bank balances of 4.47 million ringgit.